Today, we're going to dive into a crucial topic, and that is how to effectively pass your wealth down to the next generations. Sometimes it can feel like wealthy has the secret, has the access to set the rules and teams of accountants to their tax benefit. But today, I'm going to break down 3 major tax strategies that you can use to pass down your wealth to the next generation. This is an essential aspect of financial planning that ensures your hard-earned money and hard-earned asset actually benefits your family for the years to come. So let's get started. Before we get into the nitty-gritty detail, I just want to say that the content I share today is based on my knowledge and my experience. For your specific scenario, please consult with your own CPA and your tax attorney. First, let's talk about the estate tax exemption. As of 2024, the federal estate tax exemption is $13.61 million per individual, which means that married couple can shove up $27.22 million from federal taxes upon their passing, when they pass down their estate to their heirs. This exemption is crucial because it determines how much of your estate can be passed down tax-free. Remember, this exemption is set to decrease in 2026, potentially drop to $7 million per individual. So why is this important? If your estate exceeds the exemption limit, it exceeds the amount that would be subject to federal estate tax, which can be as high as 40%. So you want to consider gifting assets during your lifetime to reduce the size of your taxable estate and take advantage of the current exemption level before the exemption amount decreases. Number 2 strategy is adding your children to property title now while you're still alive. Let's explore this idea a little further by adding your children to the title of your property. This strategy can allow your children to benefit from a step-up basis upon your passing, potentially reducing capital gain tax when they sell the home. Let's talk a little bit about what is a step-up basis. Let's say you purchased a property 30 years ago for $50,000. Today, that same property is worth $2 million. If you were to just sell that property at $2 million, you would have to pay capital gain tax on the difference between $50,000 to $2 million. A step-up basis is upon your passing, you were able to pass on the value, today's value, to your children. In our example, is $2 million now until going forward when the property is sold, potentially completely wiping out the value of capital gain tax you have to pay over that 30 years, which is a tremendous tax saving. That tax basis is step up to $2 million and moving on forward until when the time the property is sold. That's when the capital gain tax is calculated, $2 million and forward. So consult with your tax attorney to explore how this works and how to set it up so your children could enjoy that step-up basis. By the way, if you own a rental property and the rent you're collecting barely covers your expenses, you may consider attending my upcoming 1031 exchange webinar to learn how I double my rental income with a 1031 exchange. In my webinar, we'll talk about what is a 1031 exchange, the timeline of a 1031 exchange, and the benefits of a 1031 exchange. So make sure you click the link below to attend my upcoming webinar. Finally, number 3, let's discuss the strategies for managing estate amount that exceeds the exemption limit. Let's remember the exemption limit is likely going to drop to $7 million per individual in 2026. One effective tool is the Qualified Personal Residence Trust, which is in short called QPRT. What is a QPRT? A QPRT allows you to transfer your home into an irrevocable trust, removing it from your estate and potentially lowering the gift tax amount. You can continue living in the home for a specific period of time, after which ownership transferred to your beneficiary. The benefit of that is that this strategy can significantly reduce the taxable value of your estate. Essentially, the home's value is frozen at the time of the transfer, and any appreciation occurs outside of it will be protected. Setting up a QPRT requires careful planning and timing, as a trust must outlive the grantor to be effective. It's essential to work with a financial advisor or estate planning attorney to tailor this strategy to your specific situation. So now you know the top 3 ways of transferring wealth through real estate. You may want to learn how a 1031 exchange can significantly boost your cash flow. If you want to hear more about this, sign up for the link below to attend my latest webinars on 1031 exchanges.